This is the seventh and final in a series of resources on the roles of money, the federal government, and the Fed in the economy of the United States. Part 1 considers money, how it is defined, how it is measured, and how it is created. Part 2 looks at the money market and what creates demand for money. Part 3 inspects inflation and its cost to the economy. Part 4 considers fiscal policy, defining it and its role in stabilizing the economy. Part 5 inspects the federal budget, its components, how it is funded, and what role federal deficits play in the economy. Part 6 looks at the Fed, its role, structure, and functions in the economy. The final part of the series considers monetary policy and how all the aspects of fiscal and monetary policy affect the gross domestic product. In the previous resource, we saw that one of the roles of the Fed is to control the money supply. But how exactly does it do so? The primary method is through open market operations, which is either the purchase or sale of United States government securities, also known as bonds. Bond purchases by the Fed increase the money supply, while bond sales decrease the money supply. But how does this work? Let's look at the case where the Fed looks to increase the money supply. First, the Fed buys a bond from a bank. The Fed pays the bank, which places additional money into the bank's reserves. This allows the bank more money to lend out, which increases the money supply. There are other ways the Fed can change the money supply. The Fed could change either the reserve requirement or the discount rate. Changing the reserve requirement is an immensely powerful tool in changing the money supply. Recall that any bank deposit creates a total change in the money supply equal to the deposit multiplied by 1 over the reserve requirement. That means that a 1% change in the reserve requirement multiplies any deposit by an additional factor of 100. Because changing the reserve requirement is so immensely powerful, it is not often done. The repercussions for the banking industry are too great to justify the change in the money supply. The discount rate is the interest rate at which banks can borrow funds directly from the Fed. The level of this interest rate directly affects movement in the federal funds market. In this market, banks borrow and lend reserves to each other to help ensure they cover the reserve requirement. When the Fed changes the money supply, this indirectly results in changes to interest rates. The Fed increasing the money supply creates a surplus of money. Because there is extra money for lending, banks cannot charge as high an interest rate to lend their non-reserve funds. Therefore, interest rates fall when the Fed increases the money supply. The exact opposite happens if the Fed decreases the money supply. With a lower money supply, there is a shortage of available funds for private entities to borrow. This creates additional demand for the available funds, which means the banks can charge a higher interest rate. So when the Fed decreases the money supply, interest rates rise. Now we can see the full picture of actions by the Fed. Suppose the Fed makes open market bond purchases. They pay for the bonds with money, which gets deposited into local banks' reserves. This increases the money supply. Because there is now a surplus of money, interest rates fall. This encourages companies to increase their investment spending. Ultimately, this increases the gross domestic product. The exact opposite would happen if the Fed sells bonds. How can the federal government alter the level of the gross domestic product? Well, it depends. Are we talking about the federal government by itself or by its subsidiary, the Fed? The federal government controls fiscal policy, which is the level of taxes and/or government spending. The Federal Reserve conducts monetary policy, which changes the supply of money and indirectly changes interest rates. If the gross domestic product is below full levels of employment, the government and the Fed can work together to create expansionary policies to stimulate the economy. But what about inflation? Full employment can occur with any level of inflation, so long as the inflation is expected. When the Fed creates policies to improve interest rates, they adjust the nominal interest rate. This is just a number. The interest rate that becomes more important is the real interest rate, which is what is left after the inflation rate is subtracted out. In equation form, the nominal rate equals the real rate of interest plus the inflation rate. Monetary actions by the Federal Reserve in the short run can affect the real rate by changing the nominal interest rate. In the long run, however, those actions of the Fed only affect the interest rate, as the real rate will settle back to its normal level. As with the fiscal policy of the government, there are lags in the effectiveness of the Fed's monetary policy. The inside lags for monetary policy represent the time to recognize issues and implement policy changes. For monetary policy, these inside lags are relatively short, since the Federal Open Market Committee meets 8 times per year. The outside lags for monetary policy are the time those policies take to affect the economy. Unlike the government's fiscal policy, the Fed's monetary policy tends to have longer outside lags. Most economists believe that the Fed should keep the inflation rate low and stable, rather than trying to stabilize the economy. So the full picture would be the federal government uses fiscal policy to stabilize the economy, while the Federal Reserve uses monetary policy to keep inflation low and stable.